if you look at the previous CPI number last week, you see headline inflation that's been sort of going down by a couple of tenths of a percent, but core inflation has actually been rising by a lot more than expected, so 0.6% month-on-month versus 0.3 consensus. And this is clearly because the labor market is super tight, so you have 2 job openings for every unemployed. And this is because we had millions of people leaving the labor market post-COVID in 2021. So there is clearly a huge mismatch in that regard. So the path of least resistance is to see wage inflation. And this is also being sort of made worse to some extent by companies raising prices in order to pay for these wage increases. So the genie is sort of out of the bottle in a sense.
Good morning, Kokou. Nice to see you, sir. You are fundamentally bearish on US equities at the moment. And if you're right, and you think that the S&P could go down from, and I'll just take a look, we are now 37.58, give or take the change. You think possibly we could carry on going down if the Fed carries on, down to 2,500. That is a dramatic decline from here, given where we've already come from. Just explain that, sir.
Yes, this is a very interesting point, because if you look at how the equity market is essentially behaving, so obviously there's a big mismatch between energy and oil-driven companies versus consumer-exposed companies that are already down 20 to 30%. So today we had the equity market that was pricing a recession and a recovery before the economy itself even had time to go in a recession. This is sort of the rally we had in July, August. But today we realize that the inflation outbreak is more severe. So the Fed will have to tighten a lot more aggressively than required. But the problem is it takes 3 to 5 quarters for each rates hike to have an impact on the economy and to see the consumer sort of demand rolling over. Because today you still have huge amount of savings. Cumulative excess savings is roughly $2.5 trillion, which is 10% of GDP, that is cushioning all of the tightening and cost of living crisis. So ultimately, we will see a recession towards the end of 2023, which will bring down sort of top-line growth, which again today is helped by higher prices. Nominal GDP growth or nominal sales are still higher than the input cost increases. So it's effectively a crash in slow motion, and the equity market will have to sort of realize that profit warnings are likely to occur in the next few quarters.
In terms of then the ramifications for the rest of risk on assets, if we're talking about everything you just said and the decline which could happen in the S&P, which would be very dramatic from here and wrong for a lot of people, everything goes down with this. The baby gets thrown out, yeah?
Yes, so except some sectors. So you'll have sectors around the energy transition or the green transition, because there's still a significant amount of capex and investment that will benefit some of these sectors. But otherwise, yeah, most of the sectors will take quite a bit of a hit. Even the sort of commodity market, you see that with industrial metals, copper, silver, aluminum down 20%. Year to date, which is something that's quite incredible because of the demand destruction in the industrial activity in Germany, but also in China to some extent. So I think when we see these adjustments in prices, then we'll have to think about the Fed pivot. The problem this time around is that the Fed will have to tighten or keep interest rate higher for longer because it needs to bring inflation back to the 2 to 3%. So even if inflation or core inflation peaks, we won't see the peak in interest rates only a few quarters after the peak in inflation. So, this means that the Fed put is clearly no longer here. It is clearly the Fed putting a cap on any rally. So instead of buying the dip, it's clearly an environment where you need to sell any rallies, unfortunately, in the medium term.
Okay. Can I talk about one particular sector, though? I can see that you've got a key call on long European banks, and I noticed on the back of a series of central bank meetings that we did actually have some life back in the European banks this week. What are the prospects now, as we've seen a real move away from negative rates to positive rates, with Switzerland the last one to square that shape, and effectively now we've got these banks with better profitability metrics, even if demand's compressed?
Yes, absolutely. So, the market has been sort of struggling with European banks because of the Japanification of European rates market a few years ago. So negative yields having a negative impact on net interest margins, which has been a drag for European banks. And today, higher positive real yields, which will occur over time, it's clearly beneficial for banks' profitability. That being said, it has to be sort of monitored with respect to non-performing loans, etc. But the good and positive news this time around in this cycle is that the consumer balance sheet is in a much better shape than it's been in the past. Same thing goes for corporate balance sheet because of the massive balance sheet repair that occurred in 2021 through the sort of $25 trillion of fiscal and monetary stimulus. So we are clearly in an environment where the economy is essentially not collapsing into a recession as fast as we saw in 2020 with COVID, but there's a lot of offsetting factor which create this sort of interesting environment where you have a tight labor market, wage inflation, and an economy that's holding up, which in an environment of higher interest rate is beneficial for the banking system thus far.
Kokou, just crunching out some of the numbers too on your stock market targets, the indices in Europe, it looks like we're not going to go anywhere fast for the rest of this year. But if we hold out until the end of 2023, roughly it looked on average about a 10% bounce to the end of next year.
Yes, absolutely. So I think this is where I mentioned this crash in slow motion for a reason, because a lot of businesses have essentially are benefiting from inflation. It's called greedflation. So companies with pricing power have essentially been raising their prices by more than what the input costs would suggest in terms of protecting their margins. So some are actually able to grow margins. But obviously this will only work until sort of demand starts to take a hit. And so far it's happening, but at a slow motion. So there's a transitory phase where earnings are essentially more resilient, which is why you see the equity market holding up so well despite the bond yield breaking out to the upside. And then as we get closer to more severe demand destruction and evidence that the economy is slowing down, then the market will essentially anticipate central banks pivoting. And as equity market discount asset prices and behavior by central banks in advance, then we could see a sort of rally or a bounce towards the end of 2023.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.